Stop scrolling for 1 second. If you have money sitting in Chase, Bank of America, or Wells Fargo right now, there is something happening inside the banking system that most people are not paying attention to. And it could directly affect how safe your money actually is, how much you're quietly losing every single month, and what you need to do in the next few days to protect yourself. I'm not here to scare you for the sake of views. I'm here because millions of people are keeping their life savings in accounts they haven't reviewed in years, trusting that everything is fine simply because the lights are on and the app still opens. But here's the question you need to ask yourself right now. Do you actually know what happens to your money if something goes wrong? Do you know the real limits on what's protected? Do you know how much these banks are making off of you in ways you never agreed to? By the end of this video, you will know exactly what's going on, exactly what to check in your own accounts today, and exactly what steps smart, informed people are taking right now to protect themselves. So before you do anything else, hit that subscribe button and tap the notification bell, because this channel breaks down exactly what's happening with your money in plain English before the mainstream news even talks about it. Now let's get into it. Let's start with the question everyone is quietly asking, but almost nobody says out loud, is my money actually safe in a big bank? It's a fair question. These are the three largest, most trusted names in American banking. Chase, Bank of America, and Wells Fargo together hold trillions of dollars in deposits from everyday people just like you. But size and trust are two very different things, and the truth is most customers have no idea how the system that protects their money actually works until something goes wrong. So let's break it down properly, starting with the single most important number every single person watching this needs to know. That number is $250,000. That is the maximum amount the FDIC, the Federal Deposit Insurance Corporation, will insure per depositor, per bank, per ownership category. Sounds simple, right? Here's the problem. Most people assume that if they have $300,000 or $400,000 sitting across a checking account and a savings account at the same bank, all of it is protected. It is not. If those accounts are held in the same ownership category at the same institution, only the first $250,000 combined is insured. Everything above that is technically at risk if the bank were ever to fail. Now ask yourself honestly, do you know exactly how much you have sitting at each of these banks right now? And do you know which ownership categories your accounts fall under? Most people don't, and that single blind spot is exactly why this topic matters so much right now. Here's a question that might make you a little uncomfortable. When was the last time you actually read the fee schedule for your checking account? Not the marketing page, the actual fine print. Because here's what's been happening quietly over the last few years. Regulators have been cracking down hard on what are commonly called junk fees. Things like overdraft charges, surprise maintenance fees, and non-sufficient funds penalties that historically cost American consumers billions of dollars a year, often just a few dollars at a time, spread across millions of people who never noticed. The big banks have started changing their policies in response to this pressure, some reducing overdraft fees, some eliminating certain fees altogether, and others quietly restructuring how those fees work in ways that aren't always advertised clearly. The question you need to be asking is simple. Has your bank changed its fee structure recently? And if so, do you actually understand the new rules? Because banks are not required to call you up and walk you through it. They send a notice, often buried in an email or a small paragraph in your statement. And if you don't read it, you find out the hard way the next time your balance dips lower than you expected. Now let's talk about something even more important. And this is where a lot of people get caught off guard. Interest rates on savings accounts at the big three banks are notoriously low, often a fraction of a percent, while the same banks turn around and lend out your deposits at much higher rates, keeping the difference as profit. This has always been true, but here's why it matters more right now than it has in years. With interest rates having moved significantly over the past couple of years, the gap between what you're earning at a traditional big bank and what you could be earning elsewhere has widened dramatically. Online banks and credit unions have been offering savings rates many multiples higher than what Chase, Bank of America, or Wells Fargo typically offer on a standard savings account. So here's a question worth sitting with. If your money has been parked in a big bank savings account earning next to nothing while inflation quietly eats away at its purchasing power, how much has that actually cost you over the last year alone? For a lot of people, the answer is hundreds, sometimes thousands of dollars in lost potential earnings, money that simply vanished into the spread between what the bank pays you and what the bank earns off you. Let's stay on interest rates for a moment longer, because I don't think most people fully grasp how much this actually adds up over time. Imagine you have $20,000 sitting in a standard savings account at one of these big banks, earning a tiny fraction of a percent in annual interest. Now imagine that same $20,000 sitting in a high-yield savings account earning several percentage points more. Over the course of a single year, that difference can easily be several $100s. Over 5 years, especially if you keep contributing to that balance, the gap can grow into the thousands. That's not a rounding error, that's real money, money that could go toward a vacation, an emergency fund, a down payment, or simply compounding further to grow even faster. So ask yourself honestly, if someone offered you several $100s a year for doing absolutely nothing except moving your money from one insured account to another equally safe insured account, would you take it? Most people would say yes immediately. Yet millions of people leave that exact opportunity on the table every single year simply because they've never stopped to calculate what their loyalty to a familiar big bank is actually costing them. There's also a psychological piece to this worth mentioning. Big banks have spent decades building brand trust through advertising, branch presence on every corner, and sheer familiarity. That trust is not necessarily misplaced when it comes to the safety of your deposits, since these institutions are heavily regulated and insured up to the legal limits. But trust in safety and trust in value are two completely different things. A bank can be perfectly safe and still be a genuinely poor place to keep large amounts of idle cash if it's paying you next to nothing, while comparable insured alternatives pay meaningfully more. Recognizing that distinction is one of the most financially freeing realizations you can have because it separates the emotional comfort of familiarity from the actual math of what's happening to your money. Let's shift gears and talk about something that should genuinely concern every single person watching this video, and that's the rise in banking-related scams, specifically targeting customers of these major institutions. Because these banks are so large and so well known, they've become the #1 disguise used by scammers. Fake text messages claiming to be from your bank's fraud department. Phone calls that spoof the real customer service number, making it look exactly like the bank is calling you. Emails formatted to look identical to real account alerts, complete with real logos and real sounding language, asking you to verify your identity or confirm a suspicious transaction by clicking a link or reading back a code. Here's the critical question. If you got a text message right now that looked exactly like it came from your bank, bank telling you there was suspicious activity and asking you to click a link to secure your account, would you know for certain whether it was real? Be honest with yourself. Scammers have gotten incredibly sophisticated, and the truth is that no legitimate bank will ever ask you to read back a one-time verification code over the phone or text. If anyone asks you to do that, it is a scam every single time, no exceptions. This is one of the most important things you can walk away from this video knowing, because falling for this specific type of scam has cost ordinary people their entire life savings in a matter of minutes. Let's go a little deeper into how these scams actually work, because understanding the mechanics is the best defense you have. Typically, it starts with a text message that looks completely legitimate, often arriving in the same message thread as real alerts you've received from your bank in the past, because scammers can spoof sender information to make a fake message appear in that same conversation history. The message usually claims there's been a suspicious charge, a locked account, or a login attempt from an unfamiliar device, creating a small jolt of urgency and fear. That urgency is the entire point, because a calm, rational person who takes 30 seconds to think usually catches the scam, while someone reacting in a panic often doesn't. If you click the link, you're typically taken to a fake login page that looks pixel for pixel identical to your real bank's website. And the moment you enter your username and password, the scammers have it. In more advanced versions, a scammer will actually call you directly afterward, using information you just entered to sound convincingly official and walk you through verifying your identity by reading back a one-time passcode that was just sent to your phone. That passcode is not for them, it's the final security barrier standing between them and full access to your account. And once you read it out loud, that barrier is gone. So here's a question worth remembering every single time your phone buzzes with an urgent bank alert. Am I reacting out of panic right now, or am I taking a moment to verify this independently? The safest move every single time is to ignore the link or the call entirely and instead open your banking app directly or call the number on the back of your physical card to check if anything is actually wrong. Real bank alerts will always still be there when you check independently. Fake ones rely entirely on you never taking that extra step. Now let's talk about something a little more structural, something that doesn't get discussed enough in mainstream financial media. Big banks like Chase, Bank of America, and Wells Fargo are what's known as systemically important financial institutions, sometimes referred to informally as too big to fail. This designation exists because regulators recognize that if one of these banks were to face serious trouble, the ripple effects across the entire economy would be massive. On one hand, this means these banks are subject to significantly more oversight, more stress testing, and more regulatory scrutiny than smaller institutions. That's a genuine layer of protection that smaller banks simply don't have to the same degree. On the other hand, it also means that when problems do arise, they tend to be systemic rather than isolated, affecting the whole financial system rather than just one bank in one town. So the real question isn't, is my specific bank about to collapse tomorrow? Because that kind of fear-based prediction isn't something anyone can honestly promise you. The real question is, am I personally positioned in a way that protects me regardless of what happens at the institutional level? And that's a question you actually have control over, which is what we're going to focus on for the rest of this video. Let's talk about account diversification, because this is one of the simplest and most overlooked strategies for protecting your money. If you have significant savings, spreading your deposits across multiple FDIC-insured institutions or across different ownership categories at the same institution, such as individual accounts, joint accounts, and certain retirement accounts, can meaningfully increase your total insured coverage. leverage. This isn't some exotic strategy reserved for wealthy investors. It's a basic principle that financial advisors have recommended for decades, yet most everyday people never actually implement it because they assume their money is automatically fully protected no matter how much they have at one bank. Ask yourself right now, if you have more than $250,000 sitting in accounts at a single bank under a single ownership category, do you know exactly how much of that is insured and how much technically isn't? If you're not sure, that uncertainty alone is worth resolving today. Not next month, not eventually, but today. Here's another question worth thinking about. How much of your money is sitting completely idle, earning close to nothing simply because moving it feels like a hassle? This is one of the biggest financial mistakes people make, not because they're careless, but because switching banks or opening a new account feels like a chore, so they put it off indefinitely. Meanwhile, high-yield savings accounts, many of which are also FDIC insured through partner banks, have been offering substantially higher returns for money that would otherwise be sitting stagnant. The process to open one now typically takes minutes online. The inertia of staying with what's familiar is completely understandable, but it's also quietly expensive. Every month, you leave a large balance sitting in a low-yield account at a big bank instead of a comparable insured account paying meaningfully more. You are effectively handing away money you could have kept. Let's talk for a moment about alternatives, because I don't think enough people realize just how many solid options exist outside of the traditional big three. Credit unions, for example, are member-owned financial cooperatives rather than shareholder-owned corporations, which means their entire structure is oriented differently. Instead of maximizing profit for outside shareholders, credit unions are designed to return value to their members, which often shows up in the form of lower fees, better interest rates on savings, and more personal customer service. Deposits at credit unions are typically insured by the National Credit Union Administration, or NCUA, up to the same $250,000 threshold as FDIC-insured banks, meaning you're not sacrificing safety by choosing a credit union over a big bank. Community banks are another option worth considering. Smaller regional institutions that are still FDIC insured, but often provide more personalized service and more competitive rates because they're not managing the same massive scale as a national brand. And then there are online-only banks, many of which are backed by the same FDIC insurance through partner institutions, but which operate with dramatically lower overhead since they don't maintain thousands of physical branches. Savings they frequently pass along to customers in the form of higher interest rates and fewer fees. None of this means Chase, Bank of America, or Wells Fargo are bad places to keep money. It simply means you have real, safe, insured alternatives, and comparing your options every so often is simply good financial practice. The same way you'd compare insurance quotes or shop around before a major purchase instead of automatically renewing with the first company you ever signed up with. Here's a question worth asking yourself honestly. When was the last time you actually compared your bank against its competitors? For most people, the honest answer is either never or so long ago I don't remember. That's not a personal failing, it's simply how default choices work. We tend to stick with whatever we started with, especially with something as routine and unglamorous as a checking account. But routine and unglamorous doesn't mean unimportant. Your bank touches nearly every part of your financial life, from your paycheck deposit to your bill payments to your emergency fund. A few minutes of comparison shopping done once or twice a year can meaningfully improve your financial position without requiring any dramatic lifestyle change at all. Let's talk about something practical you can do literally today, right after finishing this video. Log into your online banking app for each institution where you hold money. Check your current balance in every account. Check your ownership categories, meaning whether accounts are individual, joint, or held in trust. Add up your total exposure at each single institution. If any single bank shows a combined balance above $250,000 in the same ownership category, that's your signal to either restructure how those accounts are titled or spread the excess to another insured institution. This isn't paranoia, this is basic financial hygiene, the same way you'd check the smoke detectors in your house, even though you don't expect a fire. You're not expecting disaster, you're simply making sure the protection that's supposed to be there is actually there in your specific situation. Now, let's address the elephant in the room, because I know some of you are thinking it. Is this video trying to tell you to panic and pull all your money out of these banks immediately? No, that would be irresponsible advice, and frankly, it would be dangerous. Chase, Bank of America, and Wells Fargo are massive, heavily regulated institutions, and pulling your money out in a panic without a plan can create more problems than it solves. From missed bill payments to lost interest to the practical headache of managing cash you can't easily deposit anywhere. This video isn't about fear for the sake of fear, it's about awareness. It's about making sure you're not the person who finds out about a policy change, a fee structure, or a coverage gap only after it's already cost you money. Being proactive isn't the same as being paranoid. It's the difference between someone who checks their smoke detector batteries once a year and someone who only thinks about it after the alarm doesn't go off during an actual fire. Let's talk for a moment about customer service and account access, because this is another area where big banks have faced real documented criticism. As these institutions have shifted more of their operations toward digital banking and reduced in-person branch staffing in many areas, a lot of customers have reported longer wait times, more automated phone systems, and greater difficulty reaching a human being when something actually goes wrong with their account. If your card gets frozen for suspicious activity while you're traveling, if there's an error in a transaction, if you need to dispute a charge, how confident are you that you could get it resolved quickly? This is worth testing before you actually need it in an emergency. Call your bank's customer service line right now, not because anything is wrong, but simply to see how long it takes to reach a real person and how smooth that process actually is. If it takes 45 minutes and 3 automated menus just to ask a simple question, that tells you something important about what to expect if you ever have a genuine emergency with your account. Let's also talk about something that doesn't get nearly enough attention: how these banks make money off of the accounts you think are free. When a bank offers you a checking account with no monthly fee, that account isn't actually free to operate, it's simply monetized in other ways. Overdraft fees, interchange fees charged to merchants every time you swipe your debit card. The spread between what they pay you in interest and what they earn lending your deposit elsewhere. None of this is inherently sinister, it's simply how commercial banking works as a business model, but understanding it changes how you view your relationship with your bank. You are not just a customer, you are also, in a very real sense, the product and the funding source. Understanding that distinction helps you make smarter decisions about which accounts actually serve your interests versus which ones are simply convenient because they're the name you already recognize. One more thing worth thinking about before we wrap up. Do you actually have a plan for what you do if you suddenly lost access to your primary bank account, even temporarily? This happens more often than people realize, whether it's a fraud freeze, a technical outage, a lost card while traveling, or a dispute that takes days to resolve. If your only source of accessible cash is tied up in one single account at one single institution, a temporary freeze can turn into a genuine emergency very quickly, especially if you have bills due or need cash for something urgent. Financial advisors have long recommended keeping a small cushion of accessible funds spread across more than one institution, precisely so that a problem at one bank doesn't leave you completely stranded. This doesn't need to be complicated. It can be as simple as keeping a modest balance in a secondary account at a different bank or credit union, just enough to cover a few days of expenses if your primary account were ever temporarily inaccessible. Ask yourself, if your main bank account froze tomorrow morning for any reason, would you have any backup at all, or would you be completely stuck? For a lot of people, the honest answer is that they've never even considered the question, which is exactly why it's worth considering now, while everything is calm, rather than during an actual emergency when panic makes clear thinking so much harder. So let's bring this back to the core question this video started with: what should you actually do starting today? First, log into every bank account you have and take a genuine inventory. Know your balances, know your ownership categories, know your total exposure at each institution relative to that $250,000 insurance threshold. Second, review the actual fee schedule for your checking and savings accounts, not the marketing summary, the real document, so you know exactly what triggers a fee and how much it costs you. Third, compare your current savings interest rate against what's available through high-yield savings accounts or credit unions, and calculate honestly how much idle money is costing you in lost earnings every single month. Fourth, save the real customer service number for your bank directly from the back of your card or the official website, not from a text message or email, so you're never in a position where you can't tell a scam attempt from a real one. Fifth, if you have savings above the insured limit at a single institution, take the time this week, not eventually this week, to either restructure your account titling or open an account at a second insured institution to spread that exposure. None of these steps require you to panic. None of them require you to close your accounts or make dramatic, disruptive changes to your financial life. What they require is 15 or 20 minutes of your time to actually understand the accounts you already have, instead of assuming everything is automatically fine simply because it always has been. The truth is, most financial damage doesn't come from sudden catastrophic events. It comes slowly, quietly, from small gaps in knowledge that compound over months and years, a fee you didn't know about, an interest rate you never questioned, a coverage limit you assumed didn't apply to you, a scam text you almost fell for on a busy morning when you weren't paying close attention. Protecting yourself isn't about predicting disaster. It's about closing those small gaps before they have the chance to cost you anything at all. So here's my real question for you before you go. After watching this, are you going to be one of the people who actually logs in today and checks their accounts? Or are you going to close this video and forget about it in 5 minutes? I genuinely hope it's the first one, because the people who take 15 minutes now to understand their own money are always in a better position than the people who wait until something forces them to pay attention. If this video actually helped you understand something you didn't know before, do me a favor and hit that like button. It genuinely helps this channel reach more people who need to hear this exact information. Drop a comment and let me know which bank you use and whether you actually knew your total FDIC coverage before watching this. I read every single comment and I want to know where you're starting from. And if you haven't already, subscribe and turn on notifications, because I break down exactly what's happening with your money, your accounts, and the financial system in plain, honest language. No fear-mongering, no hype, just the information you actually need to protect yourself. Thanks for watching, take care of your money, and I'll see you in the next one.